Hey everyone, Douglas here, Kenner Market Analysis, and welcome to the weekly macro update. It is Monday, September 30th, 2019, 10:35 p.m. Eastern Standard Time as we get things rolling here. And as I mentioned on Wednesday during the Elliott Wave update, I was updating the software that I use to go ahead and record the screen capture in the video. And in doing so, and kind of tweaking with some things, I accidentally deleted the profile and scenes that I use. And so I was going to just reconstruct what I had, but I thought, you know what, why not try out something new and see if I like it. So I'm going to try with a new theme here and hopefully give me a few different options to better display data and information and that sort of thing, and just have some fun with it. So anyway, new layout. Give me a little bit of time to get all the elements back in here, but all in all, we'll see what we can make, and hopefully make it a little bit more enjoyable to watch. But most important is obviously the data and the analysis that we look at. So we will jump right on into that this evening, getting things started with the macro triangle. So let's go ahead and take a look at that, and then we'll go over all the data elements. And yeah, we've a lot to cover tonight. We'll cover kind of the normal stuff that we do, but I also want to take a look at some data that's coming out this week, and some kind of interesting things that are happening. And I really want us to piece together some of the things that I'm seeing on the charts right now too, in terms of just in terms of what's happening. And I think we're at a pretty exciting spot, maybe even more than an inflection point. Some neat things happening. So let's go ahead and get rolling with that. Fiscal flows are looking awesome. We'll take a look at those. Actually, let's go ahead and jump right on into those fiscal flows here and take a look as we finish out the fiscal year here. Today was the last day of the fiscal year, and all in all, September ended up being much stronger than last year. And actually, the headlines you're going to see, and wait for these, the headlines you're going to see is that spending was at an all-time high this year, and it was, and we continue to excel in spending, which has continued to give that base despite all the terrible data that we've seen in the rest of the world for the majority of 2019. The U.S. economy has yet to enter recession, and in fact seems to be holding afloat the entirety of the world. So all the tariffs, all the trade war issues, everything, the bad data, the slowdown in Europe, the slowdown in the rest of the world, all that, and no recession. And I think we can confidently say that it is because of the massive inflows that we've seen in a massive increase in inflows that we've seen from the fiscal side of things. So this continues to be strong. And the thing we're going to want to look for, and we're already seeing this at the end of September, I think we'll see one quick blip at the beginning of October, and then we should see a bit of a lull before we pick back up. And that could cause a few issues in the short run, but I think already from the chart that we're seeing, it might all be a moot point. Because here's the question you got to ask yourself whenever you do see any fluctuations in new money coming in, and that would be, is the market so underpriced or undervalued relative to the total amount of money that's out there that it doesn't matter that there are any kind of downturn fluctuations. And then the second thing to take into consideration too are there other things to consider? Where are rates at? Where's the dollar at? Something that's going to be important that we'll consider a little bit later. So all in all, I think the fiscal situation looks really good. We still might have some issues the first couple weeks of October, but other than that, this is a great opportunity, all things considered. And I think we could see another big takeoff in the fiscal flows as we enter the new fiscal year into the holiday season. And things are set up nice, at least through the end of the Trump first term for our presidency potentially, and the fiscal flows. Everything just remains very strong. In terms of what the setup would be for next year going forward as well. Obviously, thinking a little bit down the line here, a year down the line, if we were to get a new administration in, which it looks like there's probably an ever increasing possibility of that. I think the thing we're going to want to really keep an eye on is if tax hikes are going to be a big potential going forward. That could really slow down the fiscal growth, even though a lot of large promises would be made, Medicare for all, that sort of thing, that would have a lot of spending. I think the tax cuts might come in too. So that would be, again, something on the horizon to keep in the back of your mind if a new administration were to come in. But as it stands right now, the fiscal flows look very strong, and that kind of overall or that underlying base to the economy remains quite positive, and we'll see what comes in the first few weeks. But again, expect those headlines coming up soon to talk about how great or how big the fiscal spending was this year. They won't characterize it as great, but we know that this really gives the foundation to a growing equity sector. So with that being said, let's jump back to the macro triangle here, and we'll take a look. Let's see. Let's actually go. There we go. It's going to take me a while to get the right buttons pressed and that sort of thing, but we'll get there. So banking flows. Let's go ahead and take a look at those. One of my new favorites is the total assets from the foreign side of things. We've seen a bit of a blip up here in year over year rate of change. And again, you can see the correlation with equity. So this looks really strong. And if we take it in real terms as well, or just billions of dollars, you can see that, that in fact we actually dipped down just a little bit, but in terms of rate of change, we went up. Now on the flip side, but again, I mean the big thing is I turn this back to percent change from a year ago. The big thing that we do want to pay attention is that rate of change is at least staying steady and actually ticking up, relatively speaking, which is a good indicator of a change in terms of the current kind of path that equities have been on, which have been pretty much sideways. So good indicator there. But as we switch to risk assets on U.S. banks, the rate of change is essentially sideways week over week, slightly lower here in the blue line. However, if we go ahead and go to the actual number, it's the actual billions of dollars itself, we will see that in fact week over week we did have a bit of an increase in money added towards the risk assets, and this is to be expected since we did get that drop now last week and 2 weeks ago in bonds, and we're seeing a bit of an increase in equities. That would make sense that we're seeing that, kind of confirming our suspicions here, and I think this is really setting up nicely too as I go ahead and switch to the bond or to the treasury allocation of bank money. And it's setting up nice here that as we're seeing bond prices come down and yields come back to kind of maybe where they should be, that money is headed towards the more risky assets, which I think would be really kind of where I think we should be at this point, and kind of something I've been theorizing for a while. And so this just sets up, I'm going to make the case, actually I'll kind of start making it right now. I'm going to make the case, or my plan is to make the case, that I really think we're entering in to territory where we're going to have maybe bubble-like conditions, and we're getting pretty darn close to that. And what I mean by that is usually you get a bubble-like condition when fiscal spending crunches and you rely on that ever-accelerating growth of bank credit or bank debt being created to sustain the growth, and then banks get a little wild and they run after anything because they just need their assets to continue to increase. Well, we're not seeing the fiscal side of that happen, but what we are starting to see is the Federal Reserve kind of step in and start to get in the way, if you will. It's not allowing the fiscal flow to kind of take effect the way that it should be. So you could almost say that the Federal Reserve is kind of simulating a bubble environment by the headwinds that it's creating. And I think we're going to see that as interest rates begin to come up and bond prices begin to come down. That's kind of one component necessary for equities to at least get what they need in terms of those flows flowing in there. The next thing is, in terms of just kind of things that we're starting to see happen, are the Federal Reserve for the first time since mid 2017 increasing their balance sheet, and we saw that happen recently. This announcement came out, and again, this is going to, when they increase their balance sheet, they are taking riskier assets or even income generating assets off the balance sheets of the books, increasing the reserves kept on the books of the banks, and that squeezes the bank's ability to grow their books, especially in the short run. And I think a lot of what we've seen market hiccup-wise can be attributed over the past couple of weeks can be attributed to this push as banks have to readjust their balance sheet because of the nature of what the Federal Reserve is requesting or kind of requiring them to do. And so once that settles out, though, what you're going to get is banks doing what banks want to do, which is increase the balance sheet. And they're going to have to get riskier for this because the amount of, in order to kind of continue the growth that they've had, because the amount of space they have, because you have your kind of quadrants of reserves, right, cash assets, treasuries, and then risk assets. Well, if you can imagine, actually I could probably just sketch this out. If you could imagine, a balance sheet, reserves, let's call these treasuries, and then we'll call equities or risk assets, right? As reserves we'll make reserves blue right here, as reserves begin to creep in to the rest of the balance sheet, the equities have to go down. And not only do the equities have to go down, but they also have to, they have to go down for one, just because the reserves are taking up more of the balance sheet. So you can see the reserve. I'll get that blue color back and color this in. So now the reserves have taken up the balance sheet, and the treasuries now still have to make up. So the less riskier assets still have to make up whatever percentage it happens to be. Let's just say 70%. So now here's your treasury right here in red, and that leaves, we'll get a new color. I should have thought this out ahead of time. We'll get this kind of yellow color. This leaves even a smaller amount for the risk assets, right? Well, banks are still in a growth period, right? So initially, when this thing happens, right, they initially have to rebalance their books, right, and that's the selling that we saw. But what's going to happen is these assets, they're going to get riskier and riskier with, and they will continue to expand. And it's that riskiness that the propensity towards riskiness, that kind of Minsky model, if you will, where banks chase after riskier and riskier assets. It's that sort of situation that will emerge in this scenario, and something like this very similar happens when fiscal spending begins to crunch as well. You rely more and more on growth through the risk asset part. So all that being said, in the short run, this gets pretty exciting for kind of a rally here, exciting opportunity for a rally, as it really just kind of sets up that environment where this can kind of take off in equities. Now it ends bad, don't get me wrong, it ends in a market crash, but in the meantime, we're seeing a good setup here. Again, once things kind of settle down. All right, let's see what to look at next. So anyway, bank flows too. By the way, I should point this out, that I did drop this to bullish neutral. So I'm bullish on fiscal flows, banking flows. I'm bullish neutral. Maybe bullish neutral just as kind of a fair warning that we could see some weirdness happen again in early October, but it doesn't have to happen, as we're already seeing. I think, I'll pop open the S&P chart right here real quick. As we're already seeing, we're kind of breaking out from this flag pattern on the S&P here. Who knows if we'll get any real traction from this or not at this point, but I do think we will break out sooner or later, and then obviously take off from there. So maybe the market is just so underpriced relative to where it should be that we're just going to go ahead and take off. And that could certainly be. But again, the warning here is that there could be some odd things happening over the coming days as we switch over to the new fiscal year. Interest rates looking very strong here, very conducive to a bullish environment. Nothing to worry about there. No real run up in interest rates. Obviously, remain kind of low. The worry is going to start to be when we get to kind of what was happening in bonds and rates. We can look at this back and say, late 2018 or something like that. That can certainly cause some issues. And then let's see, it would have been the exact date would have been Yeah, because we had that run up in late 2017 as well that really kind of created a tough scenario here. But we're nowhere near those levels and nowhere near that kind of rate of change either. So I'm not worried about interest rates at all going forward. In fact, I mean, if anything, it's quite positive. Sentiment momentum. The selling last week kind of spooked the sentiment polls here. Bullishness dropped back down. Bearishness picked back up above average, and then bullishness below average, respectively. So that looks pretty good. Again, giving some good room to run here, and what I do think will be quite the rally for the last couple months of the year. Now, some things I want to look at next in terms of rest of the world. I'm still going to say neutral bearish at this point. We have some interesting data coming out though already this week. German unemployment had quite the surprise to the upside in terms of employment, but unemployment actually went down quite unexpectedly. And I think this could be the first sign that maybe things might be turning. But we have a very big day tomorrow for manufacturing PMI for the Eurozone and for the U.S. So a lot of big data coming out. Very important to watch this. And I think if we get some surprises here, I think this could be the first tell that the world economy is maybe not as bad, or at least kind of that initial push might be over for kind of a snowball effect downward, and that we might be seeing at least a pause here in global kind of economic downturn. So big day. I'm certainly expecting, I think, an increase. I know the consensus is an increase in manufacturing PMI for the U.S., and I think we might get a beat. Partially based on just kind of where I think like lumber prices, some of our leading indicators, but this could be a good tell. Obviously, I think the U.S. economy is quite strong, but I rely a little bit more heavily on the European manufacturing PMI numbers. Manufacturing is a lot stronger or larger portion of the economy, both not only in Europe but also globally relative to the U.S. And so it's important to kind of see how the rest of the world is doing manufacturing wise. So that will be some very important data to come out, and I think could potentially spur a bit of a rally going forward, or at least indicate that we might be heading up soon. All right, let's see. In terms of the rest of the world too, another thing I want to look at, very interesting comments by Mario Draghi. Just kind of a long-term, kind of on the horizon sort of thing, something to keep an eye on. He did mention that the ECB should examine new ideas like MMT. The question is exactly how this would come out, but he did at least mention that some ideas of kind of people's QE or something like that might be necessary or could be necessary. Taking the politics out of the side of this, clearly the monetary policy in the Eurozone has not been effective whatsoever, and I think a lot of that is because, and as I mentioned in the past many times, we've seen a very strong constriction on fiscal stimulus, if you will, on the Eurozone side. They're effectively zero growth in terms of what we would be relative to their fiscal flows. They're running almost a budget surplus. It's a very small deficit in the ECB as a total. So, which corresponds to the weakness that they've had in terms of growth. So, interesting to see a big name come out and say that something like this might be a benefit. Obviously, exactly to go from theory to practicality, who knows how something like this would get implemented. But fascinating to see this headline, and something worth keeping an eye on if something like this gains traction. I think if you were to see a big influx of fiscal flows for the Eurozone, not only would that recapitalize the banks, I think that would in the long term actually help the euro. I think maybe in the short run you could see some fluctuations, but more importantly, it would potentially save the Eurozone as a whole. If that's kind of the goal. But in the meantime, until something like this happens, I think the Eurozone is still kind of the Titanic, just waiting to finally go under. It's kind of hit the iceberg, if you will. Which brings me to my next thing that I want to take a look at, and that is going to be what's happening in the euro and what's happening in the dollar on the flip side. We're seeing some great movement. This is something that I have been anticipating, waiting for quite some time to happen. We have been patiently, slowly following this grind up, and we're starting to see some breakout. Obviously, the dollar making highs that we haven't seen for over 2 years now. And the progress continues. And from the Euro USD side, this just looks like a waterfall. I mean, it looks like it could absolutely give way here, and we could see some major moves. And for me, what this really does is set off a couple things. One, the long dollar play has been something I have been thinking is probably the highest possibility move for quite some time. And in fact, if you're relatively new here, or you didn't see it the first time, or you just want a refresher, I highly recommend, and I'll put this in the description, this link in the description below. In fact, let me go ahead and copy that right now as a reminder to put that in the comment section in the Patreon feed. Watch this video, because this is where I lay out what the euro dollar system is, what the tick data is, everything you need to know about why I would be bullish the dollar, and why I think eventually the dollar has to rise. It really has to do with an unraveling of the euro dollar system. And that is kind of the first step that has to happen amongst many steps to kind of finally end this cycle. And depending on how this happens, we could see some really vicious things play out. So I think things are going to start to get exciting one way or another. The first step is, of course, the dollar taking off. And there are a couple things we want to see happen, and a couple things that I think, at least my theory would, the way I kind of see it happening, would expect to see happen. One, kind of like I've heard it put this way, like the dollar milkshake theory, which is as the dollar pushes higher, it's going to draw money to it or funds to it. And I really think that makes a lot of sense, and it's something I've thought for a while, that I think as the euro dollar system unravels, that we're going to see capital flight from the rest of the world to the U.S., particularly because dollar-denominated assets are going to look more and more attractive as the dollar goes up, because of kind of the uncommon nature of the unravel. And so I think we should see, if this is kind of the beginning of the end, I think we should see a rally in equities, which we're setting up for. Certainly, it looks like we want to break higher from a technical perspective too. We should see the dollar rally, and to a certain extent, I thought maybe even see gold hold on, although I'm not necessarily stuck to that idea. But we should see at least the dollar and equities move together, which they really haven't much in kind of historical sense, but we should see them begin to correlate. And I think when we finally see that, that'll be a good indication amongst taking a look at other kind of data indicators that this kind of dollar unwind, or the euro dollar unwind, is happening, and this dollar milkshake theory is playing out. So I think we are really nicely set up. I say all this to kind of lead into, I think we're really nicely set up. I know I don't have it in on the screen. I got to get a widget to put on the screen that shows the trade layout that I'm at. But I'm still heavily, I haven't made any trade since, but it's still about 66% equities, and then what is it? Or maybe it was 55% equities, and then 2020 dollar and bonds. But I think that setup sets very nicely, and I think both those push higher. And anyway, it sets up a discussion of what to do then. Well, what I really like to do, and kind of what my plan was, is as the dollar were to take off, I figured bonds would be in a little bit better position here, and that I'd actually be profiting. And what I'd like to do is get rid of that bond play and go ahead and shift it towards the dollar to take advantage of both of those equity and dollar moves. And I do think kind of the biggest risk is that the dollar pauses for a while and pushes sideways. But if that were to happen, we'd still see a rally, and then in equities, and then resumption in the dollar. So from a positioning standpoint, that's kind of how I'm thinking things right now. So if you see a trade soon from me getting out of the bond long, it's not so much that I'm cutting my losses, it's that I just think that money is better off in the dollar, and just makes more sense going forward. So yeah, some exciting things happening in the dollar. Like I said, make sure you check out the video here April 20th was when that was uploaded on the Patreon page, and you can check that out. Like I said, I'll link it. This will give you a good explanation of what I think is about to take place, and pretty exciting stuff. Really unfolding in the market, stuff we've been actions occurring, markets unfolding in ways that we've been very patient to see, particularly the dollar, but are finally happening. And not much more to say than that, other than things are playing out as expected, and this should really be the first couple dominoes falling of some exciting things that could take us into the new year and beyond. So that will wrap up this update here, and we'll try and get the new widgets and everything put on the trade layout, and hopefully this looks good, and play with some new ideas. But otherwise, good setup in the markets this week, so good trading, everyone, and we'll see you next time.